This stuff is really fascinating when you get into it. So this morning we walk in at 8:30 Eastern and claims jump. What, 53,000? That's a big move, especially when you're starting with 200. Just think about it in percentage terms. That led to a very weak Chicago PMI, weakest in 2 years. Now, we did have a nice jump in new home sales, but I think that what's going on is the long end of the curve is really monitoring the data. The short end of the curve is thinking about the data as well, but almost for different reasons. Remember, there was a time where we talked data dependent, but it was a myth. This gentleman, Jay Powell, really is looking at everything and trying to gauge how to adjust policy. The markets and investors have to go right along with him. So we've had parallel shifts today. 2 years moved down because rising initial claims and weak Chicago PMI and calls for tomorrow's jobs report to be half the gains of last month makes the Fed not look more aggressive. And the long end took that economic data and ran with it as well. But the result was a parallel shift, and that is important because by watching the curve, I think what we will learn is when the data starts to separate itself from maybe what the Fed will do, we'll see the curve either flatten or steepen. And right now, it really has remained mostly the same. The other variable that I think is very important to get into now is that dropping yields and dropping dollar are making many think that this move is going to get legs. As I take a step back, certainly we could melt more, but in the final analysis, I really do think if we're not going into a recession, and I don't believe we are, there will be a bigger move to the upside, but it's going to have to be fueled on some fresh data when we get a look at fourth quarter GDP and some of the catch-up numbers, because claims is real time, but new home sales was November.
Good point, Rick. Rene, the other thing besides the Fed and the data is, of course, earnings. What sort of messages are you getting out of earnings season?
Well, you know, this quarter so far has been kind of up and down. We talked about that, and the industrials have really been hit hard. We have very grave concerns about what the first half of this year is going to look like, honestly. At the end of last year, we all know we had a very volatile time. Earnings were kind of all over the place, and we now are going to have this additional impact with the federal government shutdown, the longest in history. So the initial impact that we see with GDP growth, for example, for the fourth quarter is going to be down 0.1%. For the first quarter of this year, down 0.2, but that's a preliminary number. There's going to be a lot of companies, I think, that are going to be very negatively impacted by what has happened. Then we have in the next 60 days a few other elements. Brexit. The China talks are still going on, and hopefully we don't get back into another Fed shutdown. So I'm really concerned that the earnings are going to be very, very negative. And we're waiting now for opportunity to get back into the market. Cash was the best asset class last year. And probably for the first half of this year, it will be too. So once we hit that, I think we'll be ready to go.
January's been a really strong month for stocks.
I know, but that's just January. So it still is, you know, we're kind of bouncing back off of that, but I am very clear, and I've already talked to a lot of my clients, and so we are kind of moving into more of a safe mode right now.